Okay. Hi, everybody. Good to see everybody. Pretty good turnout. Today's topic is statistical validation, the end game in trading education. The fifth section of really what we teach at Trading University is benchmarking, and benchmarking is statistical validation. And I've always known how important that is. And it was really brought home to me how important statistical validation is by one of our students, Connie. Connie, actually met Connie on FX Street. And Connie was telling me that she's like, I love the benchmarking because it's really the end game of all this. She said, in the past I saw trading education is a bit of a merry-go-round, and that you get on it, you're all excited, it's going around in circles, you're having fun initially, but pretty much you realize it just keeps going around in circles. There's no end game to a lot of education programs. And I understand that too. I mean, if you look at when you went to school in a university, they're there to prepare you for the real world, but they can only take that so far. But she loved that benchmarking or statistical validation got her off that merry-go-round. It got her off away from going in circles and proved to her that she was ready to trade live. So statistical validation, very important in trading. I also need to remind everyone that trading involves risk of loss, and it's not suitable for all investors. Trading is a mesmerizing business. It could be addictive as well. All the more need for viable education, all the more need for to have that education benchmarked so that you can demonstrate for yourself that it works. Essentially, you can prove to yourself that it works. Hi, Mr. Rashid. Good to see him. And we better define benchmarking. Statistical validation is benchmarking. We define benchmarking as backtesting or forward testing a trading method to record every trade it generates to the letter of the trading plan to capture the statistics of that method to determine if the potential outcome is worth the risk. In trading, that's what it all comes down to, is risk. We have to understand that risk. I don't focus on the reward. I focus on the risk. I'm an optimistic person. I'm not pessimistic, but I understand that focusing on that risk, eliminating risk, shrinking that losing percentage as much as I can, that's the way to go. Then once in a trade, then we could focus on the reward of it. The first thing you're going to need to benchmark your method is a static trading plan. A static trading plan that lends itself to repetition. Static means the trading plan does not change. So regardless of the market itself or the economic environment, your plan is constant for any market or for any time frame. I hear people saying, here's today's trading plan. I don't understand that. The trading plan should be the same all the time. The trading plan, very similar to what the checklist a pilot goes through before he flies a plane. It's the same every time. The same thing should be with your trading plan. If you have a different trading plan, then you can't benchmark that trading plan. You can only benchmark that. Well, you can't. In order to benchmark something, you have to measure it over the course of time in different environments to see how it works. So you need a static trading plan, one that does not change. You also need to understand that benchmarks are hypothetical. You are recording every trade over a 24-hour period per day, and you're doing that 5 days a week, and you're managing those trades to the letter of the trading plan. It's okay the trading plan is hypothetical. From my perspective, it's actually better that it's hypothetical because someone could show me live trading results, but I don't know if they followed the plan or they didn't. And I understand that it would be pretty difficult to stay awake for 24 hours a day, 5 days a week, right? And catch every trade, and even probably more so follow that trading plan to the letter. Most people jump out too early, or they don't allow profits to run, or they'll cancel a stop. So a benchmark is hypothetical, and that's okay. I'd rather see hypothetical results over a long period of time than just short-term results that an individual can show me. The point is that hypothetical is better because it's going to be a more accurate reflection of that overall trading plan. Now, before you can trade, to me, before I would even consider a trading method, I want to see the hypothetical results. Once I see the hypothetical results, I can determine for myself if that method's going to provide the rewards necessary to put in the time to study it and then to demo trade it and eventually to live trade it. Important to know that benchmarks are hypothetical. The benchmark is going to validate your trading plan, and it's going to be a strong indication that you're ready to move from analyst to demo trader. Okay? You need to have a method before you can trade. You need to know the results of that method before you even start to study it, right? Before you put the time into demo trade it or trade it live. Basically, here's a trading plan that we focus on. It's a little bit more detailed, our live one, but this is pretty darn close to it. And you have to have all these 4 steps in here as far as the method itself, the setups, the signal, the management. You have to have those in order to get to a benchmark, okay? You have to have a trading plan, and this is an example of a static trading plan. This trading plan doesn't change. It's the same trading plan in all different markets on all different time frames. You have to have one of these to get one of these. This is a benchmark spreadsheet for euro US dollar on our day trade method, and you can see we're trading a 3 and a 15-minute chart right there. It's taking the signal on the 3, managing the second half of the trade on the 15-minute, and this is a benchmark of our day trading method. Keep in mind, it is hypothetical. Again, no one's going to be able to stay awake to catch all those trades, and no one's going to follow them to the letter of the plan. So this trading plan, this benchmark spreadsheet is to the letter of the plan. It's for the month of November, so it gives us a pretty good idea of what we can expect if we were to study that method and then go on and demo trade that method and test it for ourselves. So you have to have one of these, a trading plan, to get one of these, a benchmark spreadsheet. So we're going to cover these 4 things that you need to get that, and you need a trading plan that's going to show you that. Number 1, you need to know which levels to buy and sell at. Okay, we're going to get to that. Most people don't realize this is actually number 1 for a very good reason. So number 1 is which levels to buy and sell at. Number 2 is which market and direction to focus on. I didn't get that backwards. Most people, they focus on a market and direction first, then the level. No. Focus on the level, then the market and direction, and we're going to show you that today. Number 3 is when to buy and sell. That's going to be your setup for sure. You need to know exactly when to buy and sell. Number 4 is most important, how to manage your trades. And hopefully you guys have some pretty good ideas how to manage them already. We're not going to spend a lot of time on that, but we'll give you some examples. So number 1 lesson we're going to cover today is which levels to buy and sell at. Okay? Now, most people think, again, they want to focus on direction or market and direction first, or worse, they feel they need to focus on which or why a market's going to do what it's going to do. We won't go there. We're not going to focus on why a market does what it's going to do. We're just going to focus on how to put together a trading plan and show you those that benchmark so that you could see for yourself that you're going to get desirable results. Ideally, you want those desirable results. Okay, price level is first, okay? You may think that's backwards. We're focused on price level before market and direction, but really it's price level that creates the price pattern. And the price pattern, in other words, it's your current highs and lows in a market. So it is that pattern, it's those current highs and lows in a market which tells us whether a market is bullish or bearish. That's why we put price level first in our studies, and we'll give you some examples of that, okay? Because it's all about that statistical validation, okay? We're moving towards showing you how to have a trading plan and how to build a benchmark spreadsheet. Here's a monthly crude oil chart, and this level right here is what we call a risk tolerance threshold level. that happens to be a bearish risk tolerance threshold level. And that level is that price point where it's gonna separate whether a pattern is bullish or bearish. As long as price is below that risk tolerance threshold level, this overall pattern is bearish, okay? So it's a very simple premise. As long as price is below that level, the pattern is bearish. Here's a ETF of the Canadian dollar. If you were a stock trader and you wanted to trade the Canadian dollar, here's how you do it, okay? Once again, we have there's a bearish risk tolerance threshold level. As long as price is below that level, then this overall pattern is bearish, okay? Pretty simple premise, right? Here's a chart you're probably more familiar with. Here's the dollar Canadian. This is a mirror image of it. So therefore, this level right there that we highlight, that's a bullish risk tolerance threshold level. And you're probably guessing it. As long as price is above that level, then this overall pattern is bullish, okay? So at this point, as long as you're above that level, this pattern's bullish. So the idea is, as long as that pattern's bullish, even though prices come down significantly, look at that, you're even in the lower two-thirds of that range overall, yet the pattern's still bullish. So that's what you want to know. When price looks cheap, when price momentum's down hard, price is falling, everyone's bearish, you realize, hey, price is actually cheap. I'm in the lower two-thirds of this range, yet the pattern's still bullish, right? That's what you want to know. And here's the gold market, and here's a series of bearish. You take that overall pattern, stay below that level is bearish, 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 right? So basically what we have is a series of bearish risk tolerance threshold levels here. So what I'm showing you here is it's a static pattern. It's the same pattern that's repeating itself over and over again. So as long as price is below that RTT level, that pattern remains bearish, and we focus on sell signals. And that pattern is pretty much universal in most markets on most time frames. And there's certainly nothing new about it. Here's the same pattern in the yen. You break it down there. There's the pattern. And by the way, these lines, that's the exact same pattern every time. It's the exact same ratio, the exact same measurement each time. Okay? And here's a larger pattern. And here's a small pattern there, and here's another pattern right there. So we're focusing on identifying when price gets in that lower third of that box, or you get towards the bottom of that range, yet the pattern itself is still bullish. So this box, it was bullish here, bullish there, bullish there, bullish there. Okay. Now, what I want to make clear to you is this is not some kind of recent phenomenon. This pattern, this is not based on because there's quantitative easing or we have mass intervention in the markets. It's a simple pattern that Charles Dow recognized and talked about over 100 years ago, and Robert Ray also wrote about it in his book, The Dow Theory. There's nothing new about this pattern. There's nothing new about taking a slice of time in a market and being able to identify whether that slice of time is bullish or bearish. And then ideally you want to use that to find that lowest risk, highest reward point to enter a trade. So here we're just showing you a series of bullish risk tolerance threshold levels in dollar yen. Okay, so keep in mind, there's nothing new under the sun here. Here it is if we go back into the previous decade, here it is again in the stock Apple. Okay, see that pattern? From that low to that high, as long as you're above that level, that pattern is bullish. Now we take the larger one, and as long as you take that low to that high, as long as you're above that level, that pattern is bullish, right? And this was back in 2006, and this is the stock Apple. So again, what I'm demonstrating here is how very important it is that you have a stable, meaning it doesn't change, holistic approach, meaning it's comprehensive, to analyze and trade, which can be statistically validated, and you can do that for yourself. Now, this is just step one. Okay, this is step one, but a very necessary step. So keep, the big picture here is we're going to show you the importance of each step so that it's going to make it so much easier to validate what you're doing. So that first step that we're talking about right here is obtaining the method that, in my experience, is going to be able to measure whether a pattern is bullish or bearish. And this is how we do that. You take that pattern, it's bullish as long as it's above there. You take the overall pattern, as long as you take the low to the high, as long as you're above that level, as long as you're, in the upper 2/3 of that box or so, approximately, that pattern is bullish. And we can make that same determination. You're probably figuring out if you can make it on one time frame, you can make it on all time frames. And that's where we're going. We're going to create a ratio from that. And just to show you that it's a timeless pattern, here it is in the 90s. This is the IBM, the Stock International Business Machines. You see the same pattern in the 90s. An experienced trader will recognize right away that this is really just a simple mathematical model to be buying dips in an uptrend, right? The pattern's up. We're looking to buy dips, so it's that same. This is an identical pattern right here as it is to here. From mathematical terms, this retracement here is identical to this retracement right here. Okay. Now, I want to point out that we don't teach people how to forecast or speculate on what they think might happen in the market. We teach a simple, straightforward method which you can demonstrate for yourself the effectiveness of or the statistical performance, and you can do that in a short amount of time. That's what we're about. We want to teach you something that works and that you can demonstrate to yourself, and you can do this in a very short amount of time. In other words, we want to get you off of that merry-go-round that Connie was referring to and give you the means to demonstrate for yourself whether you can expect desirable results from your trading efforts or not. And again, this is a timeless method. This is IBM in the 90s. Here, silver in the 80s. Look at 1983. This chart is from. Here's the bullish pattern there, right? You get that predictable retracement right on the penny. And then, boom, right here, you get it again. And this time it's a bearish. You couldn't get successive closes above it, so the pattern shifted bearish here. And then we see it again. Here we have a smaller pattern inside a larger pattern. We call that a micro and a macro. And then, boom, we see it again there. So you really have the anatomy of a price reversal where the patterns are bullish and then the pattern shifts bearish here. And you guys, experienced guys, will recognize, well, sure, that's just a lower high. That's a lower high. That's right. This is a mathematical model for explaining lower highs and higher lows, right? Here's higher lows on the way up. Now you have lower highs on the way down. And that's the 80s. And here it is all the way back going to the 70s. This is a chart from 1978 in corn where you see the large pattern. You take low to high. It held that level. And now you take that smaller pattern, low to high, it held that level. So it's identical pattern here, okay? Corn back in the 70s. So ideally you want to be buying corn right there, right? That's the ideal place to buy corn, okay? Now even though the market was in the lower half here, lower third of this box, this range, it was still bullish, right? And I recommend you read Robert Ray's book, The Dow Theory. Chapter 10 goes into that. I've written a couple of books myself. I'll give you the link to one of my books afterwards. I just want to make sure I have time to get through all the material first, though. So hopefully what I've demonstrated here is the importance of understanding when a pattern is bullish or bearish, right? Because that's step number one. So step number one is knowing the level that a market is at. Okay? Once you can look at any market on any time frame and tell whether that pattern is bullish or bearish, then you have a pretty good foundation for a methodology. So number two, what a trading plan needs to show you then is which market and direction to focus on. Once you have the knowledge of whether a pattern is bullish or bearish, then you're ready to focus on different markets. And ideally, you don't even have to focus on direction because number one, that section we just went through is going to tell you the direction. I think what we demonstrated to you before was I think we did a good job of determining whether a pattern is bullish or bearish. And I think also you start to understand that there's different patterns at play in a market also. There can be bullish patterns, simultaneous bearish patterns in a market, right? A Forex gal had a great question. Which is the best time frame to determine that on? To me, any time frame, okay? Markets are fractal in nature, meaning the behavior you see on a weekly chart will be replicated on a tick chart. So to me, all of them. That's what I'm getting at too. You need a universal trading plan. You need a static trading plan that does not change, that applies to any time frame. And we demonstrate this in our live classes all the time. We demonstrated even on numbers, even on economic releases, you're seeing the exact same behavior on tick charts that you see all the way up on weekly charts in the corn from back in the 70s. You'll see that identical behavior on a tick chart last Thursday in the euro on a 20 tick chart. So even when you scroll that microscope down to the lowest levels, you're seeing that same behavior. Okay, so hopefully you understand that you can determine the direction on any time frame pattern, but there's also different patterns at play. For example, that long-term pattern is bearish because you're below that risk tolerance threshold level, right? Yet we have an intermediate term pattern that's bullish because you're above the intermediate term risk tolerance threshold level. And we have that short-term pattern which happens to be bearish because you're below that bearish designation. So price isn't always going to go exactly to that level, but as long as it's above or below that level, we can make that determination of whether that pattern is bullish or bearish. Now, this chart looks kind of confusing to you now, right? Maybe. But at least you could see that there's three different patterns at play here. The long term is bearish, the short term is bearish, the intermediate term is bullish. Okay, now we're going to take away those lines, and we're going to take that information that we just showed you in that last slide, and we're going to collate it into a ratio. So we see the ratio there. That tells us the patterns. Now we're going to apply a very simple rule to determine which direction to trade in based on this ratio, which will also determine which market we're going to focus on. Okay, we're only going to trade in the direction of the majority of the patterns in that ratio. Okay, so if you have 2 out of 3 patterns bearish, then we're looking to trade from the short side. Therefore, right there, that's going to be a sell signal for us. Okay, because it's a sell signal in line with the majority of patterns. And you see how that turned out. That sell signal that went down. This is the gold market back in November. Price had a pretty good slide down in November. That really wouldn't have surprised us at all at Trading University. In fact, you come to expect that when that ratio is bearish. So we could take each pattern on each level, and by measuring those out, we create a reliable ratio that we see in our own studies is going to be right more times than not. So that ratio tool provides a means that not as just good and help us to determine which market and which direction to focus on, but it also provides a history of which environments we are buying and selling in, which is beneficial when it comes to keeping statistics on our method, so that we can make that final determination of whether or not to risk money in a market. Remember, our focus today is all about statistical validation. We want to know the stats on a method, okay? We don't want someone to tell us it works. We don't want to feel that we hope it works. We want hard numbers that are going to validate whether or not that market's going to or whether that plan is going to continue to work for us in time. But we'll never know for sure. I mean, no one can tell the future for sure, but statistical validation, in the insurance industry, now in law enforcement, really in all aspects of our society, we're going to lean on that. We're no longer leaning on someone's experience. We're leaning on statistics. That book Moneyball, it was a great Brad Pitt movie, by the way. Moneyball, it's all about statistics. So if anything, trading should be the number one arena where we should rely on statistics, not what people are telling us. So the value of this ratio, and what I'm getting at, is it's a tool that you can go back in time and you can see how a market performed based on that ratio. Okay, so it's very easy to go back in time and see, in fact, how a market behaved in a particular environment. Okay, and the statistical information we glean from that is going to be invaluable to us as traders. And what we call that ratio or tool is a risk tolerance threshold ratio. It's a RTT ratio. And here's examples of it. The key to the ratio is that you have an odd number of patterns, right? If you have an odd number of patterns, then all you're going to do is you focus on the majority of those patterns. We focus on them just on those lower 3 time frames for the most part. But if you have a long-term established bull or bear market, I'd suggest focusing on the lower 5 of those patterns. Okay, so that's our ratio. And keep in mind, the ratio is something that we update this by hand. It's not something you need to subscribe to. It's not a secret formula. It's actually a very simple means to calculate something for yourself. And that's what we teach at Trading You. We teach you how to do that so that you can create the ratio and keep that ratio updated for every market you follow. And you can do that by hand pretty easily. We have students of ours that they're pretty technology. When it comes to technology, they're pretty savvy, but they don't go out and create. They don't let the computer do the work for them. They still do it by hand because number one, it's very quick to do it, very simple to build that ratio. But at the same time, by doing it by hand, you're staying in tune with the market. Now, I wouldn't mind. One of our students has automated. I wouldn't mind getting that, taking a closer look at that because I can cover more markets at once. But me, I like to follow just a couple of markets. I'm happy if you could trade well in one market, what do you need to be following 16 markets for, right? Which market and direction to focus on, that's the section we're in. It always comes back to the ratio. This is last Friday's chart of the euro. Okay, the unemployment number on the euro. And really which market and direction to focus on is pretty simple stuff. You're going to look for a confluence of support always in line with the ratio. So even though the U.S. number came out very bullish for the economy and the euro went down very quickly, the market stopped right on a pivot. We teach pivots in our core concept. So the market stopped right on a pivot, and there happened to be a 382. You had a 382 retracement and a pivot right there. So you had a nice confluence of support right there, right? Bam. What happened? The market stopped on a dime. Now, we're not going to say you're going to buy it right there. We don't know that. We have to wait for the signal. But certainly in here, we'd be looking to be a buyer. In here on the shorter term charts, all in here. Why? Why are we focusing on that? Because look at the 5, 10, and 20, they're up, or 25, they're up. All those short-term patterns are up. So if those short-term patterns are up, you're certainly not going to be focusing on selling, right? So you can see the pattern here. The euro has a tendency to go down very sharply, but then recover and go back up. Down sharply, recover quickly, and then start to grind back up. So when our ratio is bullish like this, why would we be doing anything other than looking to buy, right? And that's really what we're focusing on today in the euro. I'm almost tempted to exit here and go in and show you a real-time trade in the euro, what we focused on today in class, but I better stay on schedule here. So which market to focus on is always determined by that ratio. Here's another great example. Here's the market without the ratio. I have the pivots on here. Pivots are a very good indicator, by the way. This is a great way to show you how to ratio and again how to use the ratio. And again, we're focusing on market and direction. Now you can see with the naked eye that the market was making higher lows and higher highs. Then here, what happened? You had a lower high, right? Very simple stuff, right? You went from making higher lows to lower highs. So generally, if you're making lower highs, that's going to tell me, well, you're selling rallies. And you can see the pivot. The pivots were perfect. The pivots were below the market. They were providing support. All of a sudden, bam, now the pivots are above the market, providing resistance. Well, the first thing I want to ask is, before I'm going to trade that market, I want to know, what does my ratio say? And here at the time, that's my ratio. Well, my ratio is still telling me that 2 out of 3 patterns are up. So I'm not biting. I'm not taking sell signals here. I'm still focusing on buy signals, right? This particular market, I don't care if this 60-minute pattern, I don't care if I'm looking back 10 days or so. I don't care if I'm getting lower highs now and lower lows. To me, the pattern's still bullish. So I'm in a position where I'm actually looking for buy signals in this area, or at the very least, I'm definitely not looking to sell. Okay, I'm not looking to sell, therefore I'm not going to get trapped right there. And then this is, again, last Friday. This is last Friday's trade where that U.S. unemployment number came out. So we basically, as our students, we were still focusing on buy signals. So that ratio is going to be very helpful to you in that regard. Here's the U.S. stock market. Here's another example where the market's looking very heavy, right? There's a weekly pivot, right? It's chipping away. It looks like you had to close below the weekly pivot. But I can still see with the naked eye, I guess, that the pattern is still bullish here. So I'm certainly not going to get swept into looking for sell signals. Now, there's a lot of people out there that are always looking to short the stock market, okay? Yeah, here's a weekly central pivot. Now, one of these days, maybe they'll be right, okay? But I know I'm not going to try to short it until my ratio tells me to do so. Now, in this particular example, you're chipping away at that weekly pivot. The 5 and 10-day patterns are down. I'm giving you that the 5 and 10-day patterns are down. Well, that's pretty bearish, the 5 and 10. So 5 and 10 are down. U.S. stock market, pretty established bull market, though. This is the case where I would peel back, and I want to see the big picture. Just because my 5 and 10 are down, that doesn't necessarily mean I'm going to jump in and get short. I want to see what those higher time frame patterns are all about. And trust me, they didn't design stock indices to go down, right? When Wall Street came up with the stock index as a investment strategy, they didn't do that so that that would go down and people would lose money, right? No. Stock indices were designed to take the best of the stocks, put them in an index, and then people could just buy that on a regular basis, right? So very tricky trying to short a stock index that's in a bull market. That's why you need that ratio. Now, if I had 3 out of 5 down, that'd be different. I'd be selling rallies in a heartbeat in the stock market. But as long as I only have 2 down, I'm not going to take it. And what happened next? Friday happened. You had a bullish number, and now, boom, look at that. So despite those patterns being down, they all shifted back up. Actually, I need to update that. Now you're back in it. You're right back to where you were before all 5 were up. So that ratio is such a simple tool. You're gonna learn in a hurry that it's gonna keep you out of trouble. Here's dollar yen, and here's dollar yen. A couple weeks ago, you had that big switch, and boy, this is a pretty ominous looking chart, right? You don't have a lot of detail there, but when we break out the detail, in that next slide, there's your ratio. It's holding above the ratio. Well, that's good. That tells me this overall pattern I'm looking at is actually a bullish pattern. So despite that big sell-off, when the market makers reset this guy, this was a potential big breakout here above 99 even. Market makers weren't ready to let that market break out, so they had to reset everything. They had to pull it down. They had to clean out all the stops. Anyone who stopped, if you had to stop. You got long above 99 even, you had to stop below 98. Guess what? You got stopped out. You lost 100 pips. And then the market turned around and went higher. But from our perspective, even at that low point, if we know the majority patterns are up, we're looking to be buyers down here, okay? So we're looking to be buyers down there, not sellers. And so once again, that ratio is doing a great job of keeping us on the other side of the market. Now look what happens. That's that same level. Market goes down to make a higher high. Now you have all the patterns are bullish. Here, 1 second. Okay, let me get back there. So again, here you have very little definition. Next, you put that line there. That pattern is still bullish. Let me see the ratios. The overall ratio is bullish, so this one individual pattern you're looking at is bullish. The pattern is bullish. You're looking to be a buyer, right? And then what happens, the market goes a lot higher, and here's your legitimate breakout. Now, the market got, all the way to 103, the dollar yen did? The market makers weren't ready here to let it break out. So you have to understand that if you're a position trader, you can't have your stops too close. You got to have your stops way back on that. That's why we prefer the short-term trading, because we're grinders. We'd rather ideally get in there every day and chip a little out. There's a big difference between trading and speculating, but even if you are a speculator and you want those lower risk, higher return setups, and you maybe it's a hobby to you, maybe you don't want to consider it a job, because trading is a job, trading is work, trading is stress, it's work, like anything worthwhile. Maybe you don't want all that, but you're still going to benefit greatly from knowing how to be a trader, because you're going to take those lessons you learn as a trader, you're going to take those lessons you learn with us at Trading University, and then it's going to make you a better speculator or a better hobbyist. So the ratios are everything for us. So you always want to know what that ratio is, because you need to know that big picture. Because the goal is one of these, okay? That's our goal, is to have a benchmark spreadsheet that looks something like that. Now, keep in mind, these are hypothetical results. This is actually a 4-hour chart. This is a 4-hour chart. The 4-hour chart goes back for us in ETH, goes back 6 months. So this is 6 months worth of data. It's a 4-hour test. The results here are amazing to me, and I think one of the big reasons are because one of our students, who's very smart guy, he actually went back and he told me, Jay, if we focus on these lower time frames for our ratio, we're getting better results. I said, he's a pretty smart guy. He's an engineer. If I know he's telling me that, I know that he's speaking not from his own observations. He's speaking from a statistical standpoint. I know Kelly wouldn't just say that. He's an engineer. He knows the benefit of statistical analysis. So when Kelly told me that, I went back in time and I did this back test on a 4-hour chart, yet using lower time frame patterns, and we came up with fantastic results. And the statistical data that it yields is priceless for us as traders. Now, keep in mind, it's hypothetical. Again, you're not going to be able to stay awake 24 hours a day to catch every trade and then manage it to the letter of the plan. But without that hypothetical performance first, why would you spend time studying a method that if someone's telling you, hey, learn this method, you have to say, hey, show me the statistical data, right? And you have to say that to yourself first. If you're creating a trading plan for yourself, you have to say, why am I going to continue to study this if it's not giving me, desirable statistic data? Okay, how many of you guys out there where your wives or your husbands are saying, why are you spending all this time? How come you're not making money yet? Well, before you can make money, you need to prove to yourself that you have the stats, that you have the data to do that. Okay, so you have to get one of these for yourself. Now, step 3, I told you we need 4 steps before you can get there. Step 3 is going to be when to buy and sell. Step 1 was what levels to buy and sell at. Step 2 is market and direction. Step 3 is when to buy and sell. That's what we call a trade setup. Okay, when to buy and sell is our trade setup. Here's a great trade setup. Anytime you have confluence of support, in this case, this is a 3-minute chart of that last Friday's unemployment number in the euro. You have a confluence of support there. You have a central pivot in black, and you have a 382 retracement in gold. And here's what's more important: you have all the patterns up in fact. Now, when you have all the patterns up, that means you're going to look for less shallow retracements, right? We're going to get to we'll get to that Philly. We'll get to that. How do you determine the initial stop and target? And that's a very important question. That's all in your trade management also. And again, there's a big difference between traders and speculators when it comes to stops, when it comes to risk reward, and we'll cover that. But when to buy and sell, anytime you have a confluence of support or resistance and the price stops there and you get a short-term trend line break and you have the majority patterns up, you better take a hard look at that. Now, obviously, we go into a lot more detail in the course here. We're not here to cover within the course, certainly not, but we're giving you a good idea that when you get that short-term trend line break there, you get a trend line break, market stopped on support, you have the majority patterns up. That's a good time to be looking for signals, okay? The best thing about this, what I'm showing you right now, is that you're not going to be selling, right? If you take one thing away from it, it's if the majority patterns are up, you're not a seller, right? If anything, you're looking to be a buyer, right? So at that point, that's what you're looking to do. Here, too, when you have a short-term trend line break right there, you're looking to be a buyer there. Here's a trade from, actually, this is from just this morning, and that's our zone right there. Basically, we're looking for that short-term trend line break. And as always, I want to know where the patterns are. So here, the majority of patterns are up. Price gives a double bottom in our zone there. Actually, here was a double bottom, too, earlier. So this is a buy signal here, too. But there you go. Keep it very simple. You have the majority patterns up. You're looking to buy a dip and uptrend. Wait for that short-term trend line break. A very effective signal, by the way, a short-term trend line break. It's a counter trend line break. This is a counter trend move. So that's a counter trend line we put on there. When the counter trend line breaks, we go long in line with the majority of patterns. And here's another great example. Here's the retracement itself, and anytime you get a double top on a 50% retracement, this is that purple line is a 50%. So anytime you get a double top, right in or on, just beyond at or in a zone, what we call that. Anytime you get a double top at a 50% and you get that short-term trend line break, that's going to be a good signal. And it just so happened, what was our ratio? The majority patterns are down. They've been beating gold like a dog because this has been a great market to short. Because if the only people that are more stubborn than euro bears are gold bulls. Gold bulls are the most stubborn people in the world. You can beat that market like a dog now because they'll never tire from buying gold. So gold's a great trading market when you have the majority patterns down. Now, when the majority patterns are up, I'll buy gold. Okay, I'm buying dips then. But until that time, as they are, just keep selling rallies in gold. As long as the majority of your patterns are down, you just keep selling rallies in gold, and you get a double top at a 50% level with the majority patterns down. That's a really good setup. That's a nice high percentage setup. So when to buy and sell, very, very important. Now, the fourth step, because we talked about 4 steps, number 4, how to manage your trade. That's what, Philly, you're talking about where to put the stop. How to manage the trade, that's all about the stop. And probably a good time to remind you that trading involves risk of loss and is not suitable for all investors. We always need to remind you of that. Trading plan, okay? You have to have a trading plan. Very, very important. It's got to be a static plan because you're going to follow it the whole time. Trade management. Place stop beyond previous swing high or low. Sit tight. Exit half to 2/3 at a 1.5 multiple of your risk. Actually, it's closer to 1.4 we teach. Close enough. 1.5 for you guys, it's fine. It's pretty much going to be the same thing in Forex. In futures, it's a little different because you don't have a pip spread in futures. So this is very important. Exit half to 2/3 at a 1.5 multiple of your risk. And manage the balance with a momentum indicator. So your risk determines your reward, right? If your stop is going to be 12 ticks, then your reward is going to be 12 ticks times 1.4. So your initial profit target is going to be 17 ticks, right? Or pips. So if you're risking 8 pips, 8 times 1.4 is going to be 11 pips. So if your risk is 11 or 8 pips, then you're going to look to take 11 pips initially. Now, most speculators, they don't like the sound of that because they think they should have like a 3-to-1 or 4-to-1 risk reward. We're not speculators. We're traders, okay? We understand that if you're good enough to have a high winning percentage, then you're good enough to trade with a 1.4 risk reward. So very, very important that your reward is based on your stop, okay? Number 1, you have to trade multiple contracts, okay? You have to trade multiple contracts. Number 2, you need to base your initial reward as a percentage of your risk. In other words, wherever your stop goes, that variable of where that stop is giving you your first exit, your initial profit target. Then you're going to use momentum to manage that second half or that second third of the position. Okay? Use momentum to your advantage. Here's a trade from this morning in the yen future. The reason I use the yen future here is because I don't have to deal with the pip spread here. Right here, 87.08 or 97.08. See, that's the signal right here. This is our signal right there. 97.08. If I put a limit order to sell 97.08, I know I get filled at 97.08 because the next trade is 97.09. See, I'm trying to sell at 08. It trades at 09. In futures, if I put a limit at 08, it trades 09. I'm guaranteed a fill. So I am guaranteed that fill, right? So if I'm short at 97.08, the high here is 97.13, right? So I'm short at 08. I'm putting my stop 1 pip beyond that swing high. So my stop's at 14. So I'm short at 08 with a stop at 14. That means I have a 6 pip risk, right? So if I have a 6 pip risk here, 6 times 1.4, that's going to give me 8.4. So round down to 8. So if I'm only risking 6 pips here, all I need is 8 pips on this trade. So I get 2, 4, 6, 8. So I'm exiting half my trade right there. 8 ticks. Now you guys say, 8 ticks? Why are you trading for 8 ticks? Well, 8 ticks on a future, that's $100. So if I put 3 futures on right here, at this point I have a $300 profit, right? So I'm going to take 2 of those off. I'm going to take a profit on 2 of them. I'm going to take a $200 profit. I'm going to let 1 go, right? How am I going to manage that second one? I'm going to manage it based on momentum. This is a 3-minute or 2-minute chart. I took the trade on. Now I'm going to swing out to a 15-minute chart, and I'm short here from 08, and at this time price is all the way down here at 96. So now I'm going to manage that trade on the MACD. And this trade was from this morning, so I don't know. If dollar yen kept going higher, then this position kept making money. Put it that way, right? And it looks like it did. So that you get in based on the signal. Your initial target, 8 or 9 pips, is based on the risk. Then you let the profit run. And it looks like dollar yen or yen future did make a new low here. So I'm still short based on the 15 minute. So I'm using that 15-minute MACD to measure that trade now. So in the end, you're going to get a little better reward than 1.4 on that trade. But it starts out, your minimum risk reward is going to be 1.4. Hey, Boyke, so my minimum risk reward always starts out 1.4. So once I get that 1.4, I exit half of that trade, and I have the option to go into break-even stop. Technically, it's not minimum long-term because the market can back down. Just because I get out of half doesn't mean that market can't back down, right? But on this particular trade, you had a pretty good risk reward. Benchmark. The benchmark is going to provide a yardstick to compare your own demo or live trading to. Okay, you have to have that benchmark. Okay, you get, even when you're successful at it, even when you love your benchmark and you're trading live to replicate it, you still have to go back and compare your live or demo trades to the benchmark. That's going to tell you if you're following the plan or not. Benchmark is going to provide the assurance that the method is valid and can yield desirable results or not. There's plenty of traders out there, their wives or their husbands are right. They are tinkering around. They're spending too much time on that computer. They're not going to figure it out. I personally believe that most people won't live long enough or have enough money to get to the point where they want to be at without help. Okay, so that benchmark is going to determine whether your method is going to give you those desirable results or not. You got to face reality. If not, it's not. If you're not getting, if the stats aren't telling you, then you're not cutting it. So the benchmark is going to tell you, will the trading plan you're counting on make the cut? And that's what it's all about. As a trader, you got to make the cut. And here's what I've noticed too. The very fact that you're keeping a benchmark spreadsheet or not tells me where you're at on your trading journey. There's some traders, they refuse to do it. Why? Why would you not want to know statistically? Because they're afraid, okay? They put in all that work. They put in maybe years of work, and they're like, oh, my God, it's not going to work for me. So if you're not keeping a benchmark spreadsheet, if you're not statistically validating your method, then you have a problem, right? Because if you got to keep. This is, by the way, Laurent, one of our students, sent this to me. We were in class, and I was giving the U.S. students a hard time because they have it the easiest. I mean, English is their first language. We teach during the hours that are good for them. But But I was giving the U.S. students a hard time. Look, you guys aren't doing your homework. Laurent, who's I think English is his third language, he popped up. I can't believe he understands my Chicago accent. He sent in his benchmark. Here's Laurent's benchmark spreadsheet for going back September and October. Look at his results. Started out slow. His first 4 trades, 3 of them were losers. But look at over time, he really started to hammer down and really started to put up good numbers. So this is our student Laurent's benchmark spreadsheet that he sent me. As far as I know, these are hypothetical. Maybe not, though. You can see in all kinds of different markets, too. I keep one benchmark per market. Laurent was in the Euro. He was in the CAD. He was in the Aussie. He was in the Yen. He was in all the majors there. So Laurent put up really good numbers. Here again, I'm just showing you the obvious. It's going to show you on average what time of day you should be trading. It's going to show you which time frames are profitable and which environment. It's going to show you the environment. It's going to show you the effectiveness of your method in both trending and counter-trending environments, and that's really what you need. Yeah, that was in pips. Those were in pips. And by the way, Laurent's were pips. For mine, I added on a pip and a half. I added on 2.5 pips on my spreadsheets. I think I have a benchmark to come up on. For my benchmarks, Mr. CC, I add on a pip and a half to get in and a pip to get out. So my are padded by 2.5 pips. So Trading University, $199 per month membership for 6 months. Basically, you pay 1 month at a time. You pay 1 month at a time. You get access to everything up front. Okay, you get access to the advanced graduate and the new master's course, brand new master's course. That's where we teach how to benchmark. You get access to all this good stuff. You get access to everything up front too. So if you don't agree with if you don't like what you're being taught, you're certainly not going to continue to pay, right? So it's $199 till year end. By the way, prices are going up. Prices are going up by 50% at least. Yeah, I think it's going to be $299 a month. Right, currently it's $199 a month until year end, and then we're going up to. If you see the website, and here's the website. If you go to the website and the price is $299 and it's still not the new year, we can get you in at $199. But come the new year, the price will be $299 a month. So we're pretty cool about it in that you only pay for 1 month at a time, right? So if you have access to everything, you go over, you cover that advanced graduate and master's course. You look at all the archives, and we keep the archive. We teach in live classes 4 days a week. Those are archived too. So you have access to everything in your first month. So you pay $199. If you don't like it and you have access to everything, why would you keep paying, right? Just opt out of the program. Now, if you do 6 months with us, then you get a free lifetime. I should have put free lifetime here. So in other words, you're going to know right away if the method works or not, because you're being taught the whole method. You're being taught how to benchmark it. There's the website. We're doing a lot of work on the website right now. Yeah. Oh, Mr. CC asked about pips. I wanted to go back to one of the the benchmarks that I've done. These benchmarks, by the way, here's one. Keep in mind these are hypothetical results, but it's a great educational tool. Why, if you can't produce hypothetical results, if you can't do it hypothetically, why would you even risk real money, right? But the numbers you see, I added on a pip and a half on the entry and a pip on the exit. So these numbers are all padded by 2.5 pips. So you add 2.5 pips to account for the spread. So if you're lucky and you only have a 1 pip spread or a 1.5 pip spread, then you can add on a pip on each of these trades. So that's 29 trades here, you can add 29 pips to the total. So the bottom line is you have to benchmark, right? I mean, this is it right here. If you're not benchmarking, then you're afraid that your trading plan is not going to make the cut. So ask yourself, if you're not benchmarking, why not? Because, again, it comes down to this. Without that trading plan, without this, you're not going to get to this. That's the bottom line. Hey, thank you, FX Street. Good seeing everybody. I'll give you the website again. It truly is the end game in trading education. And we'll do this again 2 weeks from now. Hey, thanks, everybody. Good to see you. Thank you, FX Lady. Thanks, everybody. We'll see you next time.